We put together a cool video compiling the advice and strategies from our traders in the podcast, some of the people who trade full-time. You'll get to see how they trade, the strategies that they run, and the things they look at in the market, a bit more in depth. Hope you like this masterclass here. There's a lot of stuff in that one, a lot of value. Make sure you take some notes. Comment below what's your favorite advice, and we'll dive right in.
I think all traders need to be able to adjust. I think ultimately, I've rarely seen any EAs or robots work long time, because the problem is, unless you've got somebody actively intervening and saying, well, look, the market pattern's changed, then most of them will blow up. The vast majority of them will blow up. Whereas as a human, we can see things and say, well, hang on a minute. And we're just currently been going through this phase since Trump came to the presidency a month ago with I use the dollar index as a barometer as to what's happening and what's going on. And the dollar index was being easy for 4 or 5 months because it was just going up. So in that environment, all a trader needs to do is buy on a pullback or buy on a breakout. Now, the last month, and particularly this week, it's just been sideways and no clarity. And I just had a session with a private client this morning and just said, look, he's trying to pick trades that are going to go hundreds and hundreds of pips. And at the moment, I think that's been way too optimistic. So for me, what I say to folks is, look, once you've doubled your risk, so if you take a trade with a 50 pip stop and it gets 100 pips in profit, take some profit out. It does skew with the risk reward, but then you're in an environment where, okay, you say, and depending on how keen I am that this thing is going to keep going, I might only take 50% off and then move the stock nearer to current price and let the balance run. And then when it moves a bit further, I might take a bit more off. If I am trading something like, I think I was in the EuroCAD yesterday with a client, and he had a very optimistic target. And I said, look to the left, always look to the left. And you could see that there were previous major support and resistance areas going back years where price had rejected. So all ultimately we trade all the time is probability. And I said, the probability is this thing is going to bounce. I would take 80% off. And the other thing folks have to think about when they're in a trade, if you're 100 pips in profit and you're just trying to squeeze another 20 or 30 out, would you take that trade now where it is? And most times no. And would you risk 100 to make 20 or 30? That's an insane risk reward. So I think the main thing is the message, certainly until things calm down, be selective about which markets to focus on which day. I start every day. I use TradingView I look at where the dollar index is. I look where the Nasdaq and the S&P, where gold is, where silver is, because I'm trying to work out every day where the big money's flowing. And this morning when I got up, Bitcoin's dropped below 80,000. The S&P was been down all week, as has the Nasdaq, but the dollar's going up because money is flowing into the dollar. And as people sell assets and get out of the stock market, that goes back into the dollar. So now, today, I've said to folks, don't be in a rush to short the dollar today because all we can see everywhere is dollar strength. And then the other thing is I used to trade London, and London used to be easy, and it changed 10 years ago. Until then, there was a 10-year run from about 2005 to 2015. The London breakout, everybody had a London breakout method, because during the Asian session, price would go to sleep. And the pound, for example, used to do 150 pips a day. And overnight in the Asian session, it could do 20. So it was a 50-50 bet. It was going to go up or down. It had to go somewhere. And you just placed one cancels the other order above and below. And it really was easy to make money. But then it stopped, because nowadays the range can be 60 pips. The Asian session's a lot busier. And again, they say Japanese traders are now more active overnight as well as. So you need to change. I have used the same strategy for 20 odd years, but I have changed the emphasis. Sometimes I'll focus more on fibs, or sometimes I'll focus more on EMAs, and I've taken loads of stuff off. I mean, in my early days, as with everybody, I thought I had a wonder system, and I back tested and it looked great. And I had about CCI, RSI, volume, MACD, Bollinger Bands, 5-6 different EMAs, etc. And now I use 2, and I use MACD, and that's it. So I think that's simpler, but looking always for these multiple reasons and being able to adapt. And ultimately, if you look at the charts in the morning and you're not sure, then walk away, because otherwise you become a busy fool and you end up getting stressed. And at the end of the day, thinking, why the hell did I bother today? And generally, I can tell within 5 minutes whether it's a day to walk away. So plan. I plan everything. So for me, trading is 90% planning. I do it all on a weekend when the markets are shut. So there's nothing going on to get me excited or interfere. And, suddenly everything's moving. And I just plan levels that if things are going to drop and pull back, where do I want to buy for multiple reasons? And then I finally, as far as Forex goes, I do have a fundamental bias. And what I mean by that, and it's not global macro or anything in any depth, but I live in the Eurozone. The Eurozone politically is a mess. Economically, it's a mess. The UK, I'm from England. The UK is a mess. And the current governments in both of them are hopeless. And Trump's come in with a lot of positivity. And the business community, at least in America, are very positive about what's to come. And so you balance the two. And I just focused on the dollar for the last few months. Now we need to see in the next few weeks what happens, because I think all this chaos at the minute is to do with the tariffs and stuff. So we'll see. And finally, actually, I mentioned earlier about crypto. Do not use leverage. A couple of weeks ago when Bitcoin dropped, I think there was $2 billion worth of longs were taken out. And I saw stories of people on Twitter who had made a lot of money from crypto, lost a lot. Because if you use leverage on something that's that erratic, then you can wake up one morning and literally your whole entire account has gone. So leverage for Forex is great, but with crypto, I wouldn't touch it with a barge pole. I think the thing is when you start and you start with all the software and you read about the indicators, you put them on and you can see, well, this one seems to work. And many indicators in isolation do work. But when you start putting them all together, there's too much going on the screen. And what I've found over the years with teaching people, are really good at seeing something afterwards and saying, oh, well, I should have bought there and I should have sold that. And of course, the marketers are really clever because they show you graphs and videos saying, well, if you'd bought here and sold there, you would have made a fortune. But I find when people are learning, especially, they focus just on the current few candlesticks. And you have to look always to the left and say, well, what happened before? Where did this previously bounce and on how many occasions? And a lot of currency pairs bounced on major areas going back to 2002. So if price repeatedly has bounced in an area, the probability is it's probably going to do it. And ultimately, all we are trading, I say all the time, is probability. And if your probability is more than 50% in your favor and everything else lines up, then take the trade. And if it's not and it's 50-50, why would you take that? That's just gambling. And equally, for me, trading off smaller time frames was a terrible thing to do because I just got so emotionally involved in it and made stupid decisions, stupid mistakes. And I was doing a webinar the other day with my mentor, a guy called Rich Friesen, who's a trading psychologist. And he taught me years ago. And we were doing a thing like this where I was trading on a 15-minute chart and went to place the trade. And he just went, stop, what are you doing? And my heart rate's up, my legs are going. And I was just too emotionally involved. And like I said earlier, this is why now I do all the planning on a weekend and I look on a morning and I make a plan in advance what I'm going to do. And for me, trading is 90% planning and 10% execution. I want to place as few trades as possible to make enough money and to be able to walk away. Some people, especially when they're new, like when I was new, want to sit there and do it all day. But nowadays I find it a lot easier. Step back and play the long game is my way of looking. But I say the main thing for new people particularly is get in the habit, and it's very common sense, just look to the left. Where did it bounce before? Why? And then find as many reasons as possible. 10 years ago, I went to longer time frames. I start on weekly. I mean, we've got the monthly candle close coming, so I always have a look at that. But in general, I start on weekly. I am looking for areas of interest, big areas of interest. I look at 20 odd pairs, and then I go down to daily to try to find what I class as an A-grade trade. And an A-grade trade for me, I can show you, if you like, and show you a screenshot of what I look for the 5 reasons. and what I class to be an A-grade trade. So if that's okay, I'll share my screen. So this is the dollar Swissy, and this is the 5 reasons checklist and talk about probability. And what I explain to folks is the best thing to do is physically write out a checklist and include all of this lot. And so you're looking for trend lines, you're looking for horizontal and diagonal support. I use a couple of EMAs and Fibonacci. Correlation, I look at MACD just as a clue to see whether we're starting to top out. A risk on or risk on environment is what we've got today. So today, Bitcoin's dropping, stocks are dropping, dollars going up. That's classed as a risk off environment. People are scared of riskier assets, so they're pulling the money back into the dollar. And all of that can help you as well. And I said earlier, my fundamental bias at the minute, I am more pro USA in terms of positivity and the dollar than I am with the Eurozone and the pound. And then have another side to your list. So on the one hand, have the list and you need at least 5 reasons to tick off. And then what could go wrong? And the opposite of any of the above, to buy in here would have been a really bad decision, because if you look to the left, last time it came up here, it stopped to the pip in that area and it dropped hundreds and hundreds of pips. So the probability when you get up here that it's going to reject is greater than not, and that could keep you out of a losing trade. And again, the more that you can reduce the losers, the more profitable you will be as a trader. And so this was an A-grade trade. In fact, this was an A-grade trade this week, and I've just been taken out because I'd moved my stop too soon. But in here, when you go through your checklist, we're in an uptrend. I have it that we had 61.8 fib, and I only start paying attention to Fibonacci when we get to 50%. It also had the whole number, and I think I've forgotten to put that on here. Whole numbers. They've been really important the last few years. So in here, I had an entry. When you're near a whole number, I always go 10 or 15 pips above the whole number, because often price will come down, touch the whole number or the EMA or the fib level and move away, and you fail to get into the trade because of the spread. And so in here, I had the order at 89.20. I had the stop here, 50 pips away. This was my first area yesterday when I was thinking this is probably going to struggle. And then when it got to 1 to 2 this morning, I've taken some off because I don't know what Trump's going to say when the American market starts. And now I've taken 70% off. I'm leaving the balance to run. And now on this one, I moved the stop as I said to earlier. But what I should have done is move the stop in here for the rest of this move. And I could have caught another few hundred pips. I don't normally trade on a Friday, and I was busy today anyway, so that's my excuse. But that, for me, so from a point of view of 5 reasons, I have 61.8 fib, I have the 55 EMA on a weekly, I have the 200 EMA on a daily, I have the trend line, I have the whole number, and I have the risk-reward ratio of at least 1 to 2 and possibly 1 to 4 or 5. So for me, that makes so much sense. And then, as I said earlier, I look every day. I am looking for where is the big money flowing? And the big money flowing today and yesterday has clearly gone back into the dollar. And then everything else has been dropping against it. Okay, so this is Bitcoin today. We've clearly had a big drop, and we broke through the 200 EMA yesterday. I've got levels all the way down where I'm looking. This is the level of 75. I have an order at 76,000. I bought some this morning at 80 and some at 79, I think. Technically, this was in a flag pattern here where we were anticipating and hoping it was going to go on a run higher. A lot of this now is to do with the Trump tariffs, as I said earlier. So I'm looking at the dollar index. The dollar is going up. Everything else is going down. The stock market, the S&P is breaking lower, coming down into 78.6 fib. Until that breaks, I still think it's going to go back up. So today really is a make your mind up day. And same for the NASDAQ. NASDAQ is breaking 78.6. So the next area I anticipate it will probably react for the NASDAQ is around 20,000. And the S&P, I am anticipating it will probably react, if we get through this lot, anywhere around 5.7, 5.8. And then I'm looking at gold, as I've just shown you earlier. Gold has been at all-time highs. And ultimately, if everything else fails and the economies collapse, etc., and crypto collapses, ultimately gold is the safe haven. So I have an order to buy more physical gold at 2,810 today. And I did buy some silver this morning, and I'm in a silver trade at the moment. And I get, when it comes to silver and gold, I buy them for fundamental reasons first, and I use technical analysis to make the decision to buy. Ethereum's down and all the rest of it. So all of that lot is an indication. This for me is my barometer of where things are going today and where I need to focus. But this was a multiple reasons trade for this week. We're clearly in a downtrend of late, and especially once we've broken this bunch of EMAs in here, I have a decent risk reward on this one. So I'm risking 60 pips for a potential 240 gain. So 1 to 3 risk reward ratio in a downtrend. Another thing I look at is today, this has already done 160 pips and the average is 148. So the thinking is, if it's going to run out of steam anywhere, it's probably going to run out of steam here. And so in answer to the question about the stops, the stop needs to go where the stop needs to go, and for as many reasons as possible that you want to hide it behind. To be ultra conservative of this, I would need to go above the trend line, but then that's a 100 pip stop. And I don't go generally more than 70 pips wherever possible. So as much as possible, that's what I'm looking at. And they say it's all done pre-planned. The pound was a nice trade this week. We took the pound. This was a pullback into this area here. We had shorted in here with the initial stop up here, and then, which are 50 odd pips away. And then as the trade moved into profit yesterday, and after this spike, we moved the stop into here to reduce the risk. Because that's the other thing. Once you're in a trade, the original stop was 50 pips away. So if I'm risking 1%, now I'm only risking 0.25%. And again, I've taken some profit off and I've left the balance to run. So step by step is what I do. I only use these EMAs, and I say I use the longer time frame ones as well. But what I used to have on a chart was insane. So probability, strong areas, and as many reasons as possible are what I'm looking for every day. In general, if I start off with a 50 pip stop and it moves 50 pips into profit, I will, along the way, again, if I've got somewhere strong to hide it behind, for example, this one. So this one initially was a stop down here. Once it set off moving and moving into profit, I would come in behind the EMAs and the whole number. And then when we've got up to here, I start to go down to a 4 hour. And so if I go to a 4 hour chart, you're looking for where it's going to consolidate next. So we've come in here first, then we've clearly consolidated here and set off again. So you can move your stop into here. And then when it's consolidated again, I've gone into here and I got taken out on that one. But that's what I will do. I get it off the daily, but I will sometimes, especially in current markets, manage it from a 4 hour chart. So in theory now, I should still be in this thing, but I say because of my own mistake, I'm out. And we all make mistakes all of the time, but hey, the goal is on balance to be profitable. The main thing I say is initially, when you're in something, reduce the risk. So I had a gentleman this morning, he's been in the pound for a week or more, and he had left his stop. This was the trade here I just shown you, and I had my stop here and moved it as I explained. He still had the stop up here this morning, and I'm saying to him, well, hang on a minute, it's already gone 80 pips. You're running the risk that this thing is going to come back and take you out, but you're actually still running the risk of losing money on a Friday. And psychologically, there's nothing worse than being in a winning trade and then losing. And so at the very least, he should have moved his stop in here first and then to here. And again, for me, what I was explaining as well, I used to do, this was my main source of income. I didn't have any other source of income. And so for me, I would rather take a profit and play around with the risk reward ratio. My average win ratio is 70%. That is skewed by the fact that I do take partial profits. But at the end of the day, you need to pay the rent. You need to put food on the table from money in the bank. And there's nothing more depressing than being 100 pips up, $1,000 up, and suddenly waking up the next morning and you've lost. So I find it a lot easier. Take some profit, move the stop to entry, and then as it starts to move down, follow it, you bank profit in, and now you're risk-free in a casino. I mean, at the end of the day, I think anybody can do this. It's a step-by-step process. In an uptrend here, you're just looking for a pullback to buy. In a downtrend, you're looking for a pullback to sell, and you're looking for as many reasons as possible. Here was a multiple reason. Here was a multiple reason. On the way up, probably there was a multiple reason here. And if you're trading from daily and it's too slow for you, then you can go down to a 4-hour doing the same thing. But for me, start at the big picture, look for as many reasons as possible, and sometimes go down to a 4-hour and sometimes manage them from a 4-hour. Losing a lot of money by trading, over leveraging, and all the bad habits that you can have. I mean, I did all of them: revenge traded, over leveraged, get to the point you've lost that much that you just throw it all in, equivalent of throwing it all on number 7 in the casino. I'd say for me, it was get away from the smaller time frames. You hear the thunder? If everything starts flashing and I've gone. I did a challenge recently for a futures account, and I passed it. I got the badge, but I honestly think that it was gambling. And I have a client who is a wealthy guy, and I taught him to trade years ago, and he was always wanting to trade more. He always enjoyed it and wanted to sit there and do it. And he'd gone off and he was doing well, and then he started trading futures, and he came back to me last year and said, I've just lost 100 grand. Oh, okay, let's sit with you. So I sat with him and watched what he was doing. And I just said, you're gambling. It's just, you're looking at yesterday's high, you're looking at yesterday's low, and anything a break above and you're in. And it was so emotional. And, you know, you're talking about big money on something, and it's watching a candlestick go up and down. And I'm like, oh, no way on this earth am I going to do this. So for me, as I said earlier, the solution is zoom out, longer time frame. And because I might not take a trade this week on FX, but I've made money on other things. So be selective. Anybody can be a busy fool. And I actually last year, we had a quiet period. I think it was August last year. And we had some new members in Forex Mentor Pro, and they were getting bored. It's like, well, we haven't had a trade. So I day traded for the week. And at the end of the week, I took 10 trades. I had lost money. 3 of the trades broke my rules. Twice I got up during the night to move stops because there was news coming out. And at the end of the week, I was exhausted, and half the bad habits I had 20 years ago came flooding back. So for me, the solution is to go at longer time frames.
Tell me what people can connect with you and reach out after this interview if they want to see what you're doing and maybe learn from you.
ForexMentorPro.com is the best place to go. Folks can join for a month for $69, and if you don't like it, we give you your money back. And I mean, the main thing is the difference with others. I think we get a lot of people come to us when they're on the verge of quitting. They've bought all the shiny toys. They've listened to the YouTube gurus, and as a last, they've got the bug, but they come to us as a last resort. And I have a guy recently said he's been trying for 10 years, and we start them off and say, right, you need a business plan, you need a life plan, you need a trading plan, you need rules, you need structure. And so for anybody, irrespective of what you're currently doing, is be more business-like, be more structured and plan, and you can make money at this.
I thought day trading was where all the money is. And sure, there's money everywhere in the markets. So I just day traded, right? And it was just like, I need to make money. This is what everyone does when they trade full time. And I came to realize that day trading requires a deep set of skills. You need to be able to see sentiment and price action extremely well, volume, so that you can get in before the move happens. I was at a stage, and most people are at a stage where they use the big move to tell them, oh, it's bullish now. Now's the time to jump in. And I was always late to the party because I should have been in during that bull move. I should have used the sentiment before the move happened to tell me it's time to go bullish, right? I didn't have those skills. And so that's why I was really failing. Like you need to be early to the party, and I was always late, which most people experience that. So by the way, I day trade today. I look at stocks now as momentum. If I see short-term momentum, I'll day trade it. If I see some other type of setup, I swing trade it because I want to live my life, and trading gives me that freedom to do that. That's why I love trading so much. I can do it anywhere, anytime. But I don't want to be in front of the computer for 8 hours a day. And so I would rather put a trade on, a swing trade, a credit spread, whatever, go live my life, go golf, go have fun, and then make money in the meantime and let it manage itself. And it's easy. So I switched that because I realized the bigger the time frame I start trading on, the less I need to be perfect on my timing, the less management's going to take, the less emotions are there, because it's not like I'm in and I have to manage it. I'm going to win in 2 seconds. I've got time to be able to see what this is doing. And so swing trading just became a better fit for me because it was slower. And I ended up making way more money because my emotions were a lot calm. And I allowed myself to let the trade work a little bit better in the swing trade. And again, it was that patience side of things starting to work its way back in that allowed me to make money in swing trading. And that's what I stuck with. And until I could learn the skills to finally start incorporating everything else in between. Because now I trade everything now, but just picking one thing and sticking to that is the ideal way to go. And I would say swing trading is going to be ideal to make money for most people starting out. It's just slower. It's easier. And people want the fast, they want the excitement, but it also comes with a cost too. And that's usually where the highest skills are required. And starting out, you just don't have them. Like, you'll look at yourself in 5 years and laugh at what you thought you knew when you were first starting out. The gist of the gist, like credit spreads, it sounds complicated and it's options, but really what it comes down to is you win if the stock doesn't go somewhere. So you have a big cushion now. So instead of being correct, instead of being like, I get in, I buy shares and it has to go up in order for it to win, I win by simply having it not go below this level. So, and I can sell that level as far away as I want. So if the stock is up here, I can sell it all the way down here and it can do whatever it wants. It can go sideways, it can go up, it can go down. As long as it doesn't go all the way down through my spread, I win. And so again, at that time, I didn't have the skills to be able to predict perfectly what the markets were going to do, but I was pretty good at knowing what they probably wouldn't do. And so I was able to sell credit spreads, give myself a cushion. And if I was wrong, I would simply hedge that position, buy some other options that would make more money than the credit spread would lose. Now that I know that momentum is, I needed to hang out and it's starting to drop, I can buy some hedge. And so it's a very specific strategy. And by the way, I give away that strategy for free for anyone that's interested. So it gave me a lot of cushion to not be perfectly correct anymore. And that was a complete game changer for me. So it just made trading so much easier. So even if you don't want to hedge, you can manage it. So credit spreads are fantastic because they have a max loss. You can't lose more than what you put on this credit spread. So that's comforting in itself, right? If the markets were just if you get like a 10% gap down or gap up, you can only lose, like you have a max loss defined with credit spreads, but you also have a max profit defined with credit spreads. So what I do in my rule, if you don't want to hedge, just exit the credit spread if ever the price closes on a daily chart across your sold strike. It's hard to explain kind of over this, but that's an easy way to protect yourself, and you'll lose about 30-ish% of your max loss number at your sold strike. So that's a very easy way to manage risk. If you're like, okay, well, if my max loss is $500, if it gets to my sold strike, that means, it's given up the entire cushion that you sold, the buffers between where the price was and where you sold the spread. You were clearly, it's not working. You could get out of your sold strike and you'd lose about 30% of that. So you'd lose, $150 or so out of the 500. So people see the 500 like, oh my gosh, I don't want to lose that. It's like, if you follow my strategy in that instance, you'd lose $150. So, and then that's per like one contract. So you could do 1,000 contracts, you could do 10, you could do 3, you could do 1. But that's how I'd manage risk is, first off, you have a 90% win rate. That's where my strategy is sitting. And with credit spreads, that's very normal, right? 80 to 90% win rate. And so you've got a very high chance of winning, but in the 10% of the time that it doesn't, cut it right at your sold strike and lose small. I look at the max loss as a percentage of my trading account. So I've always taught people with credit spreads, you could do a max loss of about 10% of your trading account. I go higher because I know them, but 10% is normally what I'm telling students to kind of work their way up to, because again, you're going to lose about 30% of that. So really you're risking about 3% of your trading account on each trade, which is where I'm kind of sitting on swing trades. 1 to 3% is what I put on each directional trade, shares, whatever. So for my risk. So that brings you right into about a 3% risk of your account if you were to do a max loss of 10%, because again, you're going to exit for about a 30-ish% loss of your max loss number. So that's where I would recommend people that are experienced, they can work their way up to it. But first, paper trade, because there's so many mistakes you can make with credit spreads that can easily hurt you. So paper trade, get used to getting in and out, how your broker works, and then start with just one contract, very small. I would recommend SPY is one of the best ones to sell credit spreads on to start with. You can do very small size and just get used to how they work. And then after you've done like 20 of them, stay slow, stay easy, make mistakes with one. Don't up anything until you've made multiple mistakes. Until you're like, man, I've done this. I bought the spread instead of sold the spread or whatever. Until you've gone through lots of mistakes, do not start upping your size, because people do, again, credit spreads win all the time. So they'll do 20 trades and they're like, this is the greatest thing in the entire world. I'm going to boom, straight up to 20 contracts. And then they start making mistakes that they didn't realize. And then their mistakes are $5,000 mistakes instead of a $50 mistake. So, just take it easy, take it slow, be patient. It's not going anywhere. Credit spreads are always going to be here. It's going to work. It's worked the same way for 6 or 7 years now. So it's just stay patient, really get to know the ins and outs, experience the downsides of credit spreads before you start putting size on, so you can understand what you're playing with. And it's a great way to make money and bring in consistent income. There's a big learning curve for me. Now I teach options completely for free over at Real Life Trading, because I just don't want people making the same mistakes I did. I think education, learning the foundation, like that shouldn't cost people stuff. If you want to come trade with me, sure, come pay money and trade with me or something. But to learn the foundational pieces of trading, I give away for free, because you're already losing enough in your trading. So for me, I lost a lot learning how to trade options. I constantly did the wrong thing. There was a very steep learning curve, but once you understand how they work and understand what to do and what not to do, options are one of the safest ways to trade, because I can manage my risk extremely easy. You get all the leverage to the upside, but you don't get any leverage to the downside if you set yourself up correctly. And that's what I love about options. Whereas like Forex and a lot of those things, you have leverage on both sides, right? You can lose a lot, you can make a lot. You need to make sure you have stop management in place. With options, you only have leverage on the side that you actually make money on. Your risk is always capped. You can only lose whatever you spend on that option. So if you spend $100 on that call, it's not possible for you to lose $1,000. You can only lose $100, but yet if it works, you could make $200, $300, $400, $500. You get all that leverage to the upside, but you're not risking to the downside. So once you understand that, you're like, oh, well, that's actually really comforting. Like I swing trade with options a lot, because then I don't have to worry so much about gaps, right? Like I can go, if it gaps, I know how much I'm going to lose. Like I can't lose more than this, and I can sleep well at night, but I get all the leverage if it does work. So it is a steep learning curve. I made a lot of mistakes. A few tips here to kind of help people out. Whenever you're buying options, don't go the cheap route. Most people buy options way too far out of the money. And most people, they don't give themselves enough time. So again, whenever you're buying options, give yourself more time than you think you need on the expiration. Yes, it's going to cost you more money. So it's not going to be $50. It's going to cost you $150. It's worth it. And buy yourself a strike that's closer to the money, not out. Everyone sees the out of the money and they're like, why? I could pay $25 for this instead of $300 for this. I'm going to spend $25. The odds of you making money on that are extremely low. That's why it's cheap. Okay. So buy more like the 40 or 35 delta is a great place to start. You can learn about all that stuff. It sounds gibberish probably to everyone out there, but you can learn that stuff. When you learn that, you're like, oh, okay, I know what Tony's talking about. Just out of the money, and give yourself more time than you think, like 2 to 3 times more. So if you think this is going to happen in 3 days, buy it 15 days out, 14 days out. Like give yourself way more time than you think. Yes, it's more expensive, but you have a higher probability of making money going that approach starting out. I use technical analysis and price action as the foundation of everything that I do. Options are not going to save you. Credit spreads are not going to save you. Strategies are not going to save you, because if you don't know when to apply that, if I could give you the greatest bear strategy in the world and it would have gotten absolutely destroyed over the last year because the markets are going up. So it's not the strategy that's going to make you rich. Do you need to know it? Yes. It's like, I use this analogy everywhere. If you wake up in the morning, you go out to your car and your car doesn't start, you don't just grab like a hammer. Like a hammer does you no good. What's wrong with the car? Oh, the battery's dead. You got to figure out why it's not starting. Then the tool, pliers or whatever, wrench to get the battery off, that tool is very effective when you know what to use it on. And price action and technical analysis, in my opinion, gives me that foundation of like, what is wrong right now, right? Where is it going? So that car analogy, right? What's wrong right now? What are the markets doing? Are they bullish? Are they bearish? Are they just going sideways? How do I know that? It's price action. Price action and volume are the only thing that are going to tell you what's about to happen. Everything else is a lagging indicator. It's going off of what already happened. Price action and volume are telling you what's about to happen. It's the only two leading indicators out there in the market. So I focus on those a lot. And that way I can diagnose and go, okay, it's bullish. Strategies are just my tools now. Like, what tool do I have in my toolbox that I want to apply here? I could buy options. I could do a credit spread. I could buy shares. I could do whatever. There's 1,000 strategies that I have and that I personally trade with. It's which one gives me the greatest upside and which one can I accept the downside on? Because everything has a downside in trading. There is no just upside. Everyone just focuses on the upside and pretends like the downside's not there. But in reality, it's like everything has a downside. There's always a risk. There's always a scenario where it's not going to work. So what allows me to leverage the upside as much as I can, and what risk am I good with, and what strategy do I want to go with on this situation? So without price action, I don't have the foundation to apply my strategies and apply my ability to make money in the markets. I first got to figure out where it's going. And that would be my recommendation for people. It's like, stop learning strategies at the moment. Learn a couple. Learn price action. Learn how to read these markets so that way you can diagnose them and figure out which way they're going so that you can be with the market. You can be going bullish. And the strategy is a little bit less important. The more important thing is, are you seeing what the markets are showing you? Are you able to go bullish when it's going bullish? Or are you constantly going bearish when it's going bullish, or going bullish when it's going bearish? It's like, I would say start with that, and your results usually change quite a bit. I'm having this 360-degree approach. So I want to see fundamentals, I want to see the story, and I want to see technicals. And when it comes to entries and exits, it's all about technicals, right? I'm a breakout trader. I would say I trade 90% breakout trades and a little bit pullback trades and gap ups, but 90% breakout trades. So, and I want to have a technical entry signal. And why technical? At the end, the stock market is supply and demand, right? I can have an opinion about a stock. I can do an analysis about a stock, but I can be totally wrong on that. So when I look at the numbers and the stock is exciting for me, I want to make sure that institutions and other players in the market are looking the same way at the stock. And that's why I base my entry and my exit signals on technicals, so on the demand itself. So if something's breaking out on the upside, I know that people are paying more for the stock. And if the thing goes down, then I'm out because they change their opinion too. So I'm buying mostly breakouts, and I'm selling mostly on moving averages. So when I have a 21 moving average break, or maybe an EMA 8 break. So, and I have a lot of different sell rules which I can apply on the market, and depending really on the situation in the stock. I think that's crucial, right? If you have only one or two sell rules, that's probably not enough, because stocks are so different and can also move differently. I think mostly because I don't want to be so busy all the day with looking at the screens, right? So I would call myself lazy trader, but I'm not really lazy, to be honest, right? So lazy people do not make money in the market. And
I'm using the weekly charts because I can screen the stocks once a week. I can see the patterns that I'm looking for in charts very clearly. So I have a screening routine once a week. On Friday, I screen the markets. And then I'm looking at the daily chart for an entry. I fine-tune sometimes my entries in the 30-minute charts, but it's very rare, right? And I personally think the more you get also into lower time frames, the more you are forced to do some trades because there are more patterns, there are more things to trade. And I saw so many traders working on stock or working with stock trading in the intraday charts, and they always try to get the perfect entry into stocks. And to be honest, I always say, the stock market is not perfect. And that's why I'm also not perfect as a trader. And it's totally fine for me to get into stocks on the daily chart, right? I mean, so you get so many price information in the daily chart. That's totally enough. And I want to spend my time differently, right? I don't want to sit the whole day in front of the computer. And, I'm doing also one-on-one mentoring. I have a community running with people together. So I'm very much in contact with other traders, right? And I see that I see two things regularly, or two mistakes that traders are doing. The first thing is taking trades out of boredom. So that means they're going onto lower time frames and there is always action, and the second thing is really that they try to force trades, also in higher time frames, right? And this is something where I think, the less time you spend in front of your screens, the less there is a temptation to take any trades and force any trades, right? It comes down to emotional discipline, 100%, right? But at the end I try to make it, I try to have a distance between the market and me. And that is better with higher time frames. That's what I discovered. Every trader is different, right? You trade different than me. And every trader has a different perspective also on the market when it comes to time frames. Some people are very comfortable with daily charts, some not. Some are comfortable with intraday charts, and some of them use weekly charts. I very get often the question, why are you not using monthly charts? So because, there's always the dream of getting into a stock and then holding it forever, right? So, but that's always with the benefit of hindsight. And I always say, I'm not comfortable with the monthly chart because it is not fitting to my personality. And that's also one of the reasons why I do not trade a lot of these conservative stocks. I'm really focused on growth and momentum stocks. So try to catch some big winners. And when I trade all these conservative stocks, I'm not patient enough for that. And it's the same thing with a monthly chart, right? If I would be in a monthly chart and trading a stock for, holding it for many, many months in a row, I probably would get nervous, right? It's not fitting my personality. I need some kind of action. So, and I would start to make mistakes because of that. So this is why I choose a daily and a weekly chart, because I think, that fits best to my personality. Yeah.
How much time do you spend per day or per week on trading?
The less, the better, to be honest. So I would say every day I spend around 1 or 2 hours, so not more. Right? I'm living in Germany. I have a very, very big benefit of the time zone. So the US the US trading session is in the afternoon to the evening here. So I can plan my trades all before the market opens. And I would say I spend not more than 1 or 2 hours per day. And at the weekend and on Friday, I spend a little bit more time, to be honest, right? Because I do screening, I do some story research, etc. So I would say probably 3 to 4 hours, but that's it, And I could evenly do less, to be honest, right? If I would be more focused, if I would be more precise, then I could probably spend only 30 minutes on a day and a little bit less at the weekend. Because, but I also like to do some research during the week, so that's probably why it's 1 or 2 hours. Yeah. I have been a part-time trader for, I would say, almost 20 years. Right? I started to become a full-time trader last year, so I have been 20 years trading part-time. So everything in my life was about optimizing my routines when it comes to trading. And I'm mentoring a lot of part-time traders, and a lot of part-time traders are coming to me because, I have so much experience with that. And I think, having some distraction in your life besides trading, you are traveling, I'm doing a lot of other things, limits also the time you can spend with your screens. And, and that helps you a lot to be much, much more disciplined and more patience. And on the other side, do not waste so much time, right? I see so many traders, to be honest, wasting so much time by monitoring prices, watching charts all the day. But at the end, the most important question in trading is, how do you make decisions, right? And when I'm fully prepared, when I'm following my 360-degree approach, where I say, okay, this stock is meeting my fundamental criteria, it's meeting the story criteria, there are great technicals, then it's just then the decision to make the trade is just a question of seconds. That's it, right? And if you have some clear rules that you can follow, I think trading becomes so much easier. And then it's also easier to do that part-time, right? Yeah, I'm always orientate myself on the market, right? I'm doing consistently all the same stuff over and over again. So every Friday I run through my scans. I'm looking at the market and I'm looking from different angles on the market, right? When I screen for stocks, I already said that I'm looking for technicals, I'm looking for story, and I'm looking for fundamental. I cannot screen for story, but I have screeners for fundamental stocks. I have screeners for technical stocks. And then I build my watch list out of that. So that means I'm running probably through 300, 400 stocks on Friday. And I add only these stocks that appeal to me to my watch list. And at the end, I'm probably having something like 50 names on my watch list, a little bit more. And then I'm reducing them again. So I want not so many stocks on my list, because the more stocks, the more you have to deal with all the information coming to you. So my ideal watch list contains something like 35 to 50 names. So that is really the maximum. And then I'm doing a little bit story research. But over the years, I came across so many companies. I have the most company stories in my mind already. When I see a ticker symbol, I could say, okay, this is the story behind the company at the moment. Is it attractive? Is it not attractive, etc. And then I'm preparing a focus watch list for the week, so that I can say, okay, these 5 stocks or these 10 stocks are these stocks I want to monitor very closely during the week. And I'm looking for some entries there. So, and sometimes there are some entries triggering, sometimes not. This is something I have to accept. But to be honest, I think I'm not looking for stocks. I'm not searching for them. They always find me. I always try to be a very passive trader. Passive in that sense that, the market is there and I'm just observing the market. And when I have very strong stocks, they pop up in my scans and they come to me. And then I'm doing the research. Then I'm looking at fundamentals. And then I'm looking for a concrete entry, but searching for stocks always leads to forcing trades or mediocre setups. And that's something I always try to avoid. Not so many traders set limits for themselves. This is always something I recommend. I always say set limits, right? Do not have 100 stocks on your watch list. Try it with 50 and try to get to 35. And the same is true with a focus watch list. Instead of, monitoring 20 stocks, go down to 10, go down to 5, try it out. Because I think with more selectiveness, you have more, or you have a better quality of your setups and your stocks. And you must always ask yourself, where is it coming from? If I have 200 stocks on my watch list or 100, it's always coming from fear, right? Fear of missing out something. But if you are consistent and if you do things over and over and over again, you will learn over time that sometimes you will stumble up on some good winners. And it's not that you have to trade all the stocks, right? I try to limit myself to 3 stocks from one industry or one sector. And sometimes it's also very hard to find more really good stocks from one sector or one industry. But for example, at the beginning of the year, I made a big mistake. I made this big mistake to have too many data center stocks in my portfolio and going into the data center sell-off with that. And that also taught me one lesson, not all stocks are not all correlations are 100% visible. Sometimes you have correlations which are not 100% visible. And that also brought me to the learning that I say, okay, I also pay attention to themes, right? I don't want to have too much or too many stocks in my portfolio from the same theme, not only from the same industry or from the same sector, but you have sometimes stocks that belong to one theme, but they are in different industries and in different sectors, and you really have to keep an eye on them. So limitation also helps there. To have a good portfolio risk management. I think you can't leave out emotions 100%, to be honest. And this is also one of the big benefits to be a part-time trader or have been a part-time trader for many years. I have been working in the e-commerce sector, so that means I have a lot of knowledge about everything what has to do with technology. Over the years, I built up some intuition about technology products, software products, e-commerce products, etc. So, and this is some knowledge I can use, right? And when it comes to the story perspective, I'm always trying to get an idea about the potential growth of a company. So that means how could the company scale in the future? And this is something where you need experience, right? You cannot follow a very clear plan and say, okay, look at that. So I'm always looking at, okay, how mature is a product? Can a product be applied to many different markets in the world? Can the company expand internationally, as an example? So, and when I see that, I get a feeling for the potential growth of a company. And what I'm mostly focusing on are companies, I call them single product companies, but that's not always true, right? If you have a company which only have a couple of products, they can scale their sales and their EPS much better as you have a very diversified company, right? I give you one example. I mean, everybody was talking about General Electric as they split up in multiple different companies when it comes to the story perspective. And they said, yeah, but they are also involved in nuclear power for data centers and et cetera, et cetera. So, and at the end, but General Electric and some other bigger mature companies, they are so diversified that at the end, if you have one good product, it has no impact on the sales and EPS at all, right? And this is why I prefer rather single product companies, because they can scale their sales so fast. And this is something you have to find out. You have to find out what are the attractive products and services in a company, and you have to find out how is the impact of the sales from this product on the overall company sales and the EPS. And you need experience for that. You need experience, you need some intuition and also some knowledge about what is going on. But I'm very interested in almost everything. I'm always reading a lot about companies, technologies, and with all these activities, I get more experience also in companies. But to be honest, there are also some sectors where I have no knowledge about. Biotech is one of them, which is super difficult, and everything what has to do with basic material stocks, right? So oil stocks or I don't know, uranium stocks or something like that, they are all the same for me. So I just trade them on technicals. But, to do some story picking in technology stocks, I think, or for me, it's easier to get behind the story.
So the people who lost a lot of money didn't have sufficient knowledge looking over the whole thing. So, I mean, I go into this in detail. I've just released my second book, which is on trading plan, and risk management for those sorts of crashes are part of what I teach in that book. But at the end of the day, all these crashes are potentially perceivable. One of the things I did early in my education was I had data back to 1980. So I went back to 1987, and by mid 2000, just on what I'd learned from basic support and resistance, you'd have been out of most equities between 6 and 8 weeks before the crash in October of 1987. You have a look at that market was a 5 1/4 year bull run from 82 into October 87. the crash at the end of 2007 was easily understood when, not necessarily when, but the fact that it was going to end was easily understood when you look back in history. These massive bull runs just do not continue. They always fall. It's just a fact. So coming into end of 2007, we had a 4.5-year bull run. That's only 3/4 of a year less than the crash of 87. And then you started getting the volatility and the wild fluctuations from about September of 2007, and you just knew that the end was coming. So you just got to position yourself and get ready for it. And another example I'd give in that trading plan book is the decoupling of the euro from the franc from the euro. The Swiss National Bank did the decoupling in January of 2015. And you could tell something was going to happen. The range of movement of each day was about 50 or 60 pips. Suddenly it closed down to 6 to 9 pips. That's something that's happening. Someone's moving stuff around then. So then basically I went to the currency futures contracts, and I looked at the January, February and March contracts, and the volumes were enormous. The open interest was, of course, because they were unfilled. Most of them were unfilled at that point in time, so it was just pure open interest. The volumes were enormous, so you knew something was going to happen. What was it? Didn't know, but something's going to happen. The big boys are positioning themselves. So on H4, one of the franc pairs formed a descending pennant. So I actually entered the pennant, and that entry was about 3 or 4 days before the decoupling. So if you know what to look for, where to go looking for clues. I mean, you've got to be a detective in this industry. If you want to avoid getting caught by crashes, you've got to be a detective in some way, shape, or form. You've got to have an inquiring mind and go looking. If you don't, if you just blindly follow what other people are saying, then you're going to get hurt, you're going to get caught. Initially, I was taught trend changes, just trend changes on equities, on weekly. And then I was taught patterns. And that's basically all I did for 10 years. Just trend changes and patterns. Patterns I tended to specialize in because I love the subjective nature of them. And there's a lot of rubbish written on them. Every dog and his would-be author are trying to write about patterns, but all they're doing is regurgitating the same product, the same words. I had the two big encyclopedias, the McGee and Edwards and the Bulkowski encyclopedias, and they were just full of words but no real meanings. There was no really indicative way to trade them, no specific identification criteria or confirmation for higher probabilities. So I went searching for a lot of that, and found some methodologies there that do give you a higher probability, especially on triangular formations. There's very specific breakout window on triangular formations, and outside that, your probabilities drop immediately to 50% or less. So, and that just takes a lot of work and a lot of time and a lot of exercise.
Was that more intraday or was it more swing trading?
No, what people classically call swing trading is often reversals. I actually work on the reversal signals rather than the actual the high and low turning points. I want to see confirmation of directional change as well. But that sort of came later. I didn't get into reversals until probably about 2012. Up until about 2010, it was rising support, falling resistance breaks for trend changes. And even that is not as simple as just putting on a line and taking a break of the line. There are areas of confirmation that you can use to get higher probabilities. There's an old saying in the industry, well, in any industry, if one thing gives you an answer, there's a probability of failure and a probability of success. If two different things give you the same answer, you've got a higher probability of success, which is why I always look for confirmation in some way, shape, or form before I enter anything. It does tend to cut out a lot of losing trades. But yeah, trend changes and patterns up until about 2009, 2010. And then I started looking at more continuation patterns, more continuation entries and reversals, and spent a lot of time on those, developing reliabilities for those. But that's basically it. Essentially, you're looking at directional change, trend changes, patterns, and then external other continuation entries and reversals. They're basically the 4 different structures that I use. Can't spend 9 hours a day in front of a computer screen looking at 5-minute charts. I go crazy. I work predominantly on daily and H4. I find there's a lot of noise. When you get sub H4, there's a lot of noise. And the other thing that a lot of people don't realize is their platform's timing can be a big effect on your consistency. Right? Trading platforms are either GMT plus or minus 0 or GMT plus or minus 2. Well, plus 2. But then in summertime, they go to GMT plus 1 and GMT plus 3. Now, the problem with GMT plus or minus 0 is that you've got a 2-hour day on Sunday when Frankfurt opens at 10 p.m. Eastern time. Then you've got 4 24-hour days, and then you've got 1 22-hour day. So that screws up anything that uses an average is automatically screwed up because you've got 6 trading periods. If you're looking at daily, for argument's sake, you've got 6 trading periods, 1 of 2 hours, 4 of 24 hours, and 1 of 22 hours. So say a moving average for the week is totally different on that platform than it is on one that's GMT plus 2, which basically shifts the timing so that the market opens at midnight, that European time, and then you've got 5 24-hour days in the week. So your moving averages are normally worked off closes. So as you can imagine, when you look at a 2-hour difference in each day, the closes are going to be different. Therefore, your moving averages are going to be different. Therefore, your MACD is going to be different. And anything that means moving averages or combined averages of anything is going to be different. The RSI is going to be different because it measures the up closes versus the down closes. And when they're different, everything changes on the charts and on the indicators. And most people just don't understand it. They don't understand that difference, and it makes a big difference to the way the charts look as well.
That only affects the forward chart and above, though, no?
2 hours and above. Right, on MT5, you can go to 3 hour. But yes, sub 2 hour and sub 2 hour makes no difference. But on anything above 2 hours, it makes a big difference too. And for me, I work on daily and H4, so it makes a big difference for me overall. But also when you're working on equities on those charts, longer time frames on equities keep a lot of the noise out of it. So that just, again, if you're looking at equities on a Forex platform that's on GMT plus or minus 0, that creates a big difference in anything using averages that you're using to identify or confirm anything. And most people don't realize it. They don't know the timings. They don't understand how it affects anything. And that catches out a lot of people. And that's another thing in this industry. You've really got to be observant of price action because it does change. Most people in the industry, I'll take patterns as an example because I spent so much time and effort on patterns. And that was my first book, was specializing in patterns. There's a lot of stuff written and it's all the same basic stuff. What people don't think through is that they think everyone's their enemy on the markets and everyone's against them or they're against everyone else. What they've got to understand is most people know the same basic stuff about patterns and therefore they know where the basic stops go, as a prime example. And this is where the market's changed in late 19, early 20, and then through to 21, and they've remained the same since, is that the patterns lost a lot of reliability. So flags, pennants, and triangles, for argument's sake, they lost a lot of reliability because where the basic stops were automatically placed by people who read all the basics on them, and the reliability went down. So I just spent time looking and observing, and you could just see it happen. You could see the manipulation. So I changed the stops on them, and I got the reliability back. But if you're not observant of price action and being able to look at changes, then you're not going to pick up on that, and you're going to lose your reliability. And all it is just the big boys pushing price around, and they're not out there to get the average trader. We don't have the volumes that they require. But they know where the other institutions are putting their stops, so they'll just crash the pricing down straight through there to pick those orders up as their liquidity. And they're not chasing you or me. We're not big enough for them to chase, but they'll chase other banks on that. And so observing that, okay, we've lost reliability. Why? Okay, go back and have a look at every one of them. Well, how would I have avoided that? If I shift the stop to this level, below that, I've actually eliminated 90% of the losing trades that suddenly developed because of manipulation in the price action that's actually changed in late 19 and early 20. So you do have to be a bit of a detective and you do have to be observant if you want to stay successful. Constantly changing. Everything changes constantly. These financial markets are no different, really, when you actually look at them. There's so much daily noise and fluctuations on equities in each and every day. Weekly charts on equities tends to cut out the interdaily noise, or the interweekly noise, and you tend to get more reliable longer run instead of being constantly in and out. Works very well on equities. Doesn't work well on Forex. It can be worked on Forex. You can. I know one trader who's a very good friend of mine. He works off daily and weekly, and all he does, he sits there and watches all. He doesn't even sit there watching that much. He develops the main zones of reversals that they have, and when it's heading towards that reversal, he just places the relative order to catch the change of direction, because essentially a lot of the pairs range between certain boundaries. He doesn't put stops on. Therefore he doesn't get stopped out. He gets into a drawdown situation, but then when the reversal actually happens and gets past his entry, he's back in profit until it gets to the next reversal. So there's different ways of doing it. There's no single way of doing anything. Everything I do is just based purely and simply on price action. I look at the price, what it's doing, what it's telling me. It's like road signs. Every road sign will tell you something, but if you don't know how to read it, you're going to get lost. If you've ever been, are you in the States, Etienne, or whereabouts are you? In Thailand, okay. If you come from a country like Australia where we have one type of road sign, then you go to the States with those big clover leaves and the signs on that, right? You're used to the ones in Australia. I can read them. You go to the United States and go, holy snap and dooley, what is this trying to tell me? I do not understand it. And price action can be very similar. And you get volatility come into price action. And I'll go back to the euro franc decoupling. Suddenly you had all of these daily bars, ranges 3 pips difference, between 6 and 9 pips for the range for the day, open and close within 1 pip of each other in the middle of each bar for 9 consecutive days. Something's happening. They're building something up here. What are they trying to do? Where's it going to go? You can't just sit there and go, okay, well, I'm going to hold my long position. That's fine. I mean, look what happened to FXCM after the decoupling. They basically went broke. They had to get an emergency $300 million loan from Leucadia in the United States, and that didn't save them. They couldn't get back to a stage where they could actually make the loan repayments, and Leucadia sold them off to a European concern, and FXCM went from being the biggest broker in the world to being almost nothing these days. And that was caused by the euro franc decoupling. It's very, very difficult to make an absolute hard and fast rule about something when all it is probabilities, if that makes sense to you.
So you're saying like, oh, this is a 80% win rate, therefore next trade should be a winner. Is that what you're saying, or?
No, let me put it this way. I'll go back to a pattern example. Right? On triangular formation, the optimum breakout window is 65 to 80% of the pattern length. I've had traders come to me and say, so can I say that these things break out then? And I said, no, that's just the optimum time to break out for a trade. If you've got the most reliability on a triangular formation when it breaks out between 65 and 80% of the pattern length. 60 to 85% still works well. Outside of that, your probability immediately drops to 50% from about 75 outside of that window. But he was trying to make a hard and fast rule. So I have to take this at that break. No, it also depends on what price action is doing. Because you get the breakout, well, again, if it breaks out and closes back inside the formation, that's obsolete. Throw the thing away. You've lost everything. It's as long as it hasn't triggered your entry, you haven't lost anything. But that cancels the formation. Again, people try and make hard and fast guidelines and rules out of what is essentially probability of working. Traders have got to be willing to learn. They've got to be coachable. If they're not willing to learn, they're not going to make it. And that goes for any industry. Right? A good discussion with a potential student before you take them on or before you work with them gives you an insight into whether they're coachable or not. And just like a job interview, you go for a job interview in any industry. Let's say you're an apprentice. You're an apprentice for a trade. If you're not coachable, you're not going to become a successful tradesman. You're not going to become a successful carpenter unless you're coachable. If you already think you know it all, or I've read this book so I know everything. When I was working for other people and I was training their groups of students, ran into a lot of people who agreed with everything you had to say as long as it agreed with what they currently thought. The moment you stepped outside their current thought window, they threw it away. And there's a lot of people like that around. You've got to sort them out. And they've got to recognise that that's them and they're wasting their time. If they're not coachable and they've got this thought window and they're not going to think outside that thought window, then they're actually wasting their time as well. They're better off trying to go and find something else. And that really applies to every industry. The other thing with this industry is you've got all these spruikers out there telling you you're going to make a fortune in 3 months, or it's 3 months down the track you're going to be making 40% a month. Well, have you ever considered the compounding effect of 20 or 40% a month? For crying out loud. 5% a month compounded is 82% a year. How many people do you know make 82 or 100% a year? I know a few, and I'm in that bracket. But it takes a lot of time, effort, and energy to get to there. The way I put it when I'm talking to people about it is, think about this. You're in an industry where when you get to the pinnacle of your skills, you're in a position to be able to make a lot more money than a specialist doctor or a high-flying lawyer. How much time, effort, and energy did they have to put into it before they even laid hands on a client, for the doctor being a patient or a lawyer being a client? You're looking at 8 years for a doctor, and before they're flying alone, it's 12 years after your residency. Your lawyers, you're looking at high-flying lawyers, they're constantly studying and taking on new stuff. They've got to have open minds and be coachable. Same thing. So you've got to look on your education in trading basically as an apprenticeship. I've learnt this, I can progress to here. I've learnt that, I can progress to there. I can progress to here, and I can see my skills improving. And something I talk to every student about is, you're doing your back testing, which is basically practicing the skills that you've learnt. You've learnt this skill today. Go back and back test it on this. Keep track of all your achievements and your failures, just using that. Then the next time they've got something new, go back and test it on that same one. See how you've improved with what you already knew on that, and then see what this new technique has added to that. And that way they've got a visual effect of their progression as a trader. They can see the difference that they're making. It gets boring going back and testing the same pair over the same time frame, but that, to me, is, I found, the best way that you can actually see your progress as you're learning new things and adding those different skills to your tool bag. Go and retest the same thing, and then compare your results then to your results now, and you've actually got a visual, effective difference between the two, and that shows you your progression. We've all got to do the boring stuff before we get to the really good stuff.
Alright, so hope you liked it. Hope you got some value out of this one. Leave me your thoughts below in the comment section. Which advice do you relate to the most? Which one you will apply? Which guest you enjoy the most? Put this in the comment section below. You'll have links to watch the full interviews if you want in the description of the video, and the podcast show notes if you are listening to this. And we'll catch you back here in the next one pretty soon. Ciao.